So next up, we have Merlin Marr-Johnson, talk title of Project Selection, Strategic Considerations that Influence Funding.
Thanks. And John, I realise that what I should really call this talk is how to avoid a hiding. This is just basically a series of kind of observations that will help you in your project selection. And this industry, this sector is so difficult. We've kind of got to make our lives easier for ourselves by being smart, and whether that's doing early petrographic studies, a bit of mineralogy, or some of the things that I go through. It's all about making your life easier. That's a bit of our core with a bit of native copper in it from Chile. We're exploring I work for Fitzroy Minerals. We're exploring for copper in Chile, happily finding some. This is a snapshot of some of the things I've got up to over the last 30 years in the sector, starting off bottom left with Rio Tinto, where I learned how not to do exploration. I then spent some time in the city. I was an analyst. I travelled the world telling people what to buy in terms of metal cycles as a commodities analyst, and helped people like Ford Motor Companies or the big funds with their platinum, palladium, copper strategies. I was involved in the gold fix with Rothschilds. You may recognise Chris Hall's here and here. He came out and did some consultancy work with me in Kyrgyzstan, and I was looking for, in 2002, after 6 years at HSBC, I was pretty sure that the gold price was going to go up, and the best place to find it, or the best place to take advantage of the coming upswing, would be to go and explore for it where there wasn't much kind of work previously done. So I went off to Central Asia, and we had revolutions and avalanches and crazy stories. Then I went off to Ethiopia, picked up some ground which is now being developed 20-odd years later as the 2 million ounce Tulu Kapi deposit, and that's Chris Hall's looking at the alteration in the core before we had any assays. Went to South America for a couple of years, did iron ore in the boom years of 2008, 2009, ran projects all over Brazil, Peru, Venezuela. 2018, I was working in Ecuador. I'm still a director of Salazar, so I've done a little bit of South American stuff. I worked for 6 years as a portfolio manager, looked at Malawian rare earth deposits. You might recognize Frances Wall with her supervisor, Alan Woolley, and her PhD student, Sam Broom-Fedley. Congolese buyers of coltan. Uranium in Niger, spent quite a long time on that, did a pre-feasibility study on that. And this is the team that I'm working on with Fitzroy at the moment. In the pandemic, I was pulled into Crux, and I interviewed a whole bunch of CEOs. I also did a 50-lecture series called The Con, which is available on YouTube. So what I'm talking about here is on the back of 30 years of looking at what works, what doesn't, looking at companies, getting them funded, getting them drilled, and advancing them forwards. And what I've really seen is that investors reward companies that deliver. It's a pretty simple story. And I first did this presentation, or a version of this presentation, in May last year, and we were still living in a very capital-scarce environment. And I wrote success in capital-scarce times, such as these. I've taken that bit out now because things have changed. Success needs unique qualities, and the three key ingredients that I really kind of identified is that you need to have growth, you need to be active, you need to be expanding your knowledge base through getting geological information, drill results, best of all, trench results, rock chip samples. You need to be demonstrating that you're onto something in terms of grade, and mineralogy, and this is where the mineralogy comes in, of course. Linked to that, you need to have momentum. You absolutely need to be producing results, making things happen. And through that, to achieve that momentum, you need to be well-funded, and you need to have a strong shareholder register. So these are all interlinked, but effectively you need to have active drill programs for news flow. And I'll talk about this more, but you really need the freedom to work without impediment. And this is where you can be proactive, and you can make the choices of actually saying, I'm going to avoid a place where I know I'm going to get stuck. And of course, it's not just a research project. This is not an academic study. It's not a charity. You're here to make money. You've got to have an eye on value. You've got to know how you're going to make value and what the market is looking for. So at the moment, and because of the way that the sector has evolved over the last 20 or 30 years, lots of investors are looking for, have you got a route to near-term production? Because they're seeing the timelines to production going further and further out. So can you avoid the ongoing dilution? If it's going to take you 20 years to build your project, you're going to be diluted to hell and gone. All the value is going to be gone. So is there some way that you can get some small operation up and running? Can you monetize this? Is there a short-term? What can you do to shorten your timelines to production? And of course, when you come to look at a metal like copper, what can you do to reduce the capital intensity of your project? Because if you look at all of these big copper projects, they are higher, they're deeper, they're lower grade, they're further from the coast. We're talking billions of dollars, or iron ore, or coal, whatever it is. Oops. Sorry, let's go on. So as a sector, what we've had is a generation of capital scarcity. Money has been taken out of the sector. The ETF slide there on the left-hand side, data from March 2025, so March last year, $360 billion has gone into ETFs, and that $360 billion doesn't include everything that's gone into marijuana or Bitcoin. Basically, the money in the resources sector has shrunk over time. And that is money that hasn't gone into exploration. And you can see that here. This was a chart from, I think this was Tavi Costa. He was working for Crescat. He's now set up by himself. This was from late last year. And essentially, the bottom in commodities in the late 90s, that was when Gordon Brown was selling all of our gold, you may remember. Luckily, he wasn't Canadian when they sold all of their gold. And then the terrible years from 2011, 12, 13, each year I thought, this can't get worse, this is so bad. And then each year was worse than the previous one. And then even through here, it's been difficult to raise money for junior companies. And of course, we had the tech bubble, the NASDAQ boom, and NVIDIA and the big. I mean, how can the resources sector compete with these companies? That was the kind of the feeling in the markets up until about August of this year. And of course, the valuation of the entire sector was less than one of these giants. The whole mining sector, providing all of the basic materials for the entire world, less than the value of Apple. But things change. And so this looks like the share price graphs of a bunch of juniors that have just stuck a drill hole into something, and it's woo woo, here we go, boom. But that's Agnico Eagle, that's a $110 billion company. This is Cameco, that's a $50 billion company. That is Fresnillo, $40 billion company, and that is Lundin Mining, a $22 billion company, all US figures. They've just gone up 5, 6, 7, 8 times. The capital is coming back into the sector. You're seeing it in the gold price. So things are changing. Things are changing really, really quickly. But it doesn't mean that we can be dumb and just go, right, everything's going to float. Yes, you might get your capital raised in the short term with a terrible project. But to get sustained value in your share price, you've got to focus on the key features. You need to know who you are, and you need to understand the challenges that that face you. This is an image from Audiology and Industrial Minerals, an Evans edition. I got that when I was an undergraduate in the early 90s. In it, it's got a picture of all different types, going from 1 ppm up to 100% of the rock, which is salt here. You know what I should do? I should put my glasses on, and then I can see the slides here rather than actually having to read them off the board. And this is a picture of the image is from 1982. So you know, it's an old image. It's kind of whatever it is, 40-odd years old. But you need to understand the difference between when you're looking for something which is measured in parts per million, you know, gold deposit geology here, which is highly variable. You've got highly variable low continuity here and highly continuous low variability here. It's a completely different animal to if you're looking for, I don't know, bauxite or iron ore. So one's a bulk commodity, which is dependent on transport and logistics, and it's a kind of a big rock-moving exercise. The other is a value exercise on can you find the resource. It's much harder to find the gold than it is to find the iron ore, but the problems, I know we've just heard a kind of a challenging metallurgy issue on gold, but compared to the problems that arise when you deal with a VMS deposit or perhaps an iron ore deposit where you've got to map phosphorus and a whole bunch of different other chemicals and sulfur and get your geometallurgical modeling inside of your iron ore deposit, they're very, very, very different things. So you kind of need to know, is your team experienced in the project that you're looking for? Do you really understand the market? Do you understand the way that the deposits work and the challenges that you'll be faced either breaking into a sector, but also in terms of selling it? Because, for example, if you're doing copper projects, the universe of companies that are going to buy your copper project is tiny relative to the universe of people that are going to buy your gold project. And nickel, I mean, there are very few companies out there that are producing nickel. And something like potash is kind of dominated by majors. You know, it's a little oligopoly. So it's really, really hard. You've got to be very careful about what you want to do. I worked with a fantastic Australian consultant called Rolf Forster over the years. He's basically retired now, but he in 2008 he produced this little schematic in a report for me. He said mid capex suitable for the more experienced or ambitious groups, and that includes pretty bog standard minerals that you would, as an explorer, you'd normally think is kind of something you can go for: sulfide gold, maybe silver, lead, zinc, high grade copper. And he was kind of writing, saying, you've got to be really careful, you've got to really make sure that you know what you're doing if you're going to want to explore for something and advance it without making mistakes. And really the differentiator I see is whether you're going to go for pyrometallurgy or whether you're going to take something through to the concentrate stage, or maybe you can do something on the oxide stage. If you've got a simple metallurgy, if you've got something that can leach, that you can do a hydrometallurgical process, this is kind of broadly something within the remit of most people in the junior market. You can bring the skills in, you can do the capex, you can probably do this. But once you're starting getting into the pyrometallurgical side of things, it gets really, really tricky, unless you're absolutely crystal clear that you're going to be able to produce a concentrate that you can sell, because there's a concentrate market. But if you want to go down to the sorry, John, but you know, making you may have Saudi money behind you. It may be okay, but building a roaster is a big, big deal. You know, it's a lot of capital, and you've got to make sure that you're able to feed it for long enough to pay off the roaster, which is why principally the smelters of this world, the pyrometallurgical downstream processing, are in places where there's a cluster of projects and where there's abundant low-cost energy. There's a reason why most companies will only consider going to a concentrate. And it's at that point there, that cutoff, that's where I focus my kind of lecture series on understanding the process to get to there in terms of doing the geology, in terms of doing the resource estimation, the various studies that are required, and everything to that point. Once you get into this, it's a lot of money, and it's a lot of complexity. So you've got to understand in terms of your the process or the complexity of your project. But it's not just the simple value of your metal. You know, there are other things to consider here. I know it's a lot of text on this page, but this is I get an email from SP Angel every morning. They write a summary of what's happening in the market, and halfway down, they give you all of the prices. Boom. They've got precious metals, base metals, energy prices, bulk, and others. Now, the precious metals and the base metals, these are all traded on terminal markets. These are all traded on the LME, on the LBMA. You can look these up. You can pull price series going back decades. A lot of the other minor metals and the critical metals or the battery metals, they are not traded on a terminal market. You've got quasi kind of liquid markets in bulk metals and like iron ore and coal, but even then you can't really get a price, and you're going to be so specifically tied down to the exact chemical specifications of the product that you're doing. If you produce gold or you produce LMA grade A cathode from your SXEW plant, you just sell it. You've got customers right there. If you're in Chile, even better, you're opposite China. If you're in the DRC, you've got 2,000 kilometers at least to get to the port. The grades may be 10 times higher, but you're dealing with corruption and also all of that transport issues. So it's not just about the technical complexity of your project. You need to understand your market. I mentioned the number of companies out there which may be a buyer of your product. You know, what is your corporate exit? If you're not going to build it, you're going to need lots of buyers. How do you price your product? How do you value it? There are hundreds, if not thousands, of people out there who understand how to value a gold project. They've all got their own method. They'll look at NPV or they'll look at a resource dollar per ounce in the ground. But how do you value a fluorspar project or a nickel laterite project? Very, very few people know that. So it's really hard to get the value that you think you've got associated with your project reflected in your share price so that you can get appropriate funding, which is not going to cause excessive dilution to your company. So you've got to be careful about what project you choose for, you go for. Opportunity for scale. One of the key things here, I mean, this is just a suite of the critical minerals or the battery minerals. I looked up rare earth lithium, cobalt, nickel, graphite, and copper. Copper's a 27, 28 million ton per annum market, of which 4 million tons is recycled, 24 million tons is mine supply. Rare earths, I mean, 250,000 tons. Lithium carbonate, 1.5 million tons, but actually when it comes down to the lithium metal, it's sub 300,000 tons. And crucially, lithium, look at the maturity of the industry relative to the maturity of the copper industry. We've been mining copper for 8,000 years. We've been mining lithium, hard rock lithium, since the 1980s. Lithium's, the last time the lithium price spiked 6 or 7 years ago, 10 companies said, right, here we go, here's a lithium project. And it's as I said, a 1.5 million ton per annum lithium carbonate market, and you had 10 mines producing 150,000 tons of lithium carbonate. Guess what happened? The lithium price fell by 87%. It's very volatile. There's another spike in lithium at the moment, but it's a very, very immature market. There's plenty of lithium at the surface. Lithium price goes up, lithium supply will follow. Very elastic. Copper price goes up, what's going to happen? All the guys are maxed out anyway. They're absolutely maxed out on their copper production. Maybe with some mine sense work, they'll get 5% extra out of their ore, or 2%, or it'll make a lot of money. They will make money on that, but it won't change the supply-demand fundamentals. And then another thing I look at very carefully is your cost curve control. Who owns the cost curve? Who owns, is your product a byproduct metal? I mean, nickel, for example, at the moment, China owns the cost curve. Tough. Half of these things here are, China's spodumene price, China lithium carbonate. If you're going to go with graphite, for example, you need to know the exact chemical specifications. You need to have your exact Chinese customer, or your mine's not going to work. And don't get me started on rare earths. So, which commodity will you go for? And there's an obvious reason why people go for gold, because it's traded on a terminal market. You can price it really easily. It's a huge market size. It's a very liquid, it's a high-value commodity, and there are thousands of companies out there and loads of buyers. Everybody's looking for a new copper deposit, gold deposit. Standalone value. Really, this is, are you independent, or are you reliant on the government to build a road for you? Or are you reliant on another company to provide gas for you, or a railway line? So essentially, this is if you can take it out in a small truck, or a kind of a series of trucks, or maybe even a pipeline, you're okay. But if if you need a lot of logistics, that's kind of you get into the crosses down here. This is very subjective. I've used emojis. You've got to use your brains. Capital intensity. Is this something that you can get out of the ground without too much complexity? Because as soon as you start getting into really, really complex metallurgical build-outs or large-scale projects in hundreds of millions of dollars or billions of dollars, you're going beyond the scope of how you can create value as a junior mining company. And I realize that there may be major representatives of major companies in here, but again, to a degree, you've still got to have this thinking as you go through this. Sulfide gold gets a little bit more complicated, and capital intensity and the simplicity can the capital intensity can rise and simplicity can fall. I've had to add in silver. For years I've been downbeat on silver because I felt that it was a byproduct of too much lead mining, copper mining. Sorry, I'm going to have to gallop on a bit. So that, in a sense, is the choices you have to make for your project selection. But it's not just enough to work out what you want to do in terms of having how do you generate value. The other key thing is about momentum, and you absolutely need that momentum to be able to get funded. So what we've seen over a long years and years and years is that soft issues are becoming increasingly hard issues. If you haven't read this book, Mining is Dead, Long Live Geopolitical Mining, which came out about 6 months ago, I recommend that you buy a copy and you read it. It's absolutely fascinating. The industry is doing its best to a degree. You know, you've got the Extractives Initiative, I've even forgotten the acronym, but the EITI. You've got Jamie Strauss is doing his Digby thing, kind of getting certification. Oh, look at our ESG. Oh, aren't we great? Aren't we great? But these Marta and Eduardo have written this book basically saying, I'm going to read this out because it's so good. There's a profound institutional insecurity reflecting Western society's increasingly ambivalent or even distrustful perception regarding mining's strategic role in future development. The industry has lost control of its narrative, appearing in public perception as outdated, environmentally destructive, or politically exploitative. Resistance is neither anecdotal nor marginal. It is systemic and rising. Our culture, our cultural narrative, our history is written by poets and artists and filmmakers and pop singers and musicians, and there's this general view that mining is bad, and it's really come through stronger and stronger and stronger. I mean, 70, 80 years ago, you had Tolkien writing that the dwarves delved too greedily and too deep. You know what they woke in the darkness of Khazad-dûm, shadow and flame. I mean, it's really dramatic, but it's greed. It's man's greed disrupting the kind of the heavenly idyll of Rivendell and kind of the nice flowing streams. It's this us. We're the dirty, horrible miners. Look, Avatar, the world's biggest grossing film, $2.9 billion. And it's all because the miners are here destroying the planet. Look, unobtainium. Because this little grey rock sells for $20 million or 20 million a kilo. That's the only reason. It's what pays for the whole party. And it's now this kind of this meme, this theme in all of our culture. You read your children's text storybooks. I bet it's all about saving the environment and how bad the miners are. And in Pocahontas, the baddie, guess what? He's a miner. And I was just watching Now You See Me, Now You Don't 3. I know. Highbrow, huh? And guess what? The baddie is a miner. And when the baddie came on, my son, who's 22 and doing an MSc at Imperial, he said, do you think she's a goodie or a baddie? It's become, we recognize it now. Not all is not lost, of course, because we've got the Donald. We've got the Donald saying, hey, let's do some mining. But it's more than just governments saying we need a critical mineral strategy. It's more than that. You need these cultural leaders, and the person who I think has come out the strongest and the clearest is Taylor Sheridan. I don't know if you guys have watched Yellowstone, but in season 4 or 5, there's a great scene where he talks about he stops a whole bunch of sagebrush being cut down for solar panels. Because he thinks the sagebrush is a home to lots of sagebrush animals, which it is. So he's kind of anti-solar in that. And then, of course, in Landman, there's the fantastic scenes when he's out by the wind turbines explaining to the woke lawyer how the world really works. He is reflecting the world as it is, and he's got the ability to show this through these culturally powerful shows. What Hollywood and your children's books want to reflect is the cultural narrative of how dreamers would like the world to be, which is fine, except it creates problems because suddenly you can't get stuff built. I mean, if you look at the US Critical Minerals Act, effectively they're putting their hands up and saying we want resilient supply chains, we want global partnerships, and we want domestic refining and recycling. They're basically saying no mining. If you look at Europe, they say 40% of processing, 10% of extraction. Again, they're basically saying no mining. And in the US, even though Donald Trump is saying let's get mining, let's actually do stuff, when you look into the detail of this, this is a slide from Standard S&P's Global Copper Review, which is a fantastic read. It was published a couple of weeks ago. Right at the back, on figure 78, they've got this map of what is required to get a permit in the States. And from that book, Mining is Dead, they write the average time in the US to get a mineral project developed is 29 years, only surpassed by Zambia. 30 years ago, it was 6 years. So this is real. This shit is real. And you can see the plan of operations, the completeness determination, the environmental impact statement, the permit, the mine construction, the first production. And then at the bottom, there's a note saying this is a simplified illustration. In practice, multiple other federal and state-level permits are required. You know, it's really hard. You can have the big orange at the top saying let's build mines, but the legal situation is it's really tough. So what does this lead to? It leads to a map which I know is a little bit irreverent, and I'm sorry if it gets me into trouble. But I have noticed that there's a strong correlation between the high percentage of renewable energies in your energy mix. So where there are lots of solar panels and lots of windmills, you've got a society that wants lots of metal. However, associated with those windmills and solar panels is increasingly stringent ESG and permitting environment, which leads to, and there's also a correlation with high electricity prices in exactly those areas. So basically, it's the places which want the most critical minerals or battery minerals, which need more mining, but they're less likely to let you do the mining. And by the way, the electricity price is going to be a lot higher. So you can't do the processing either. So what happens is you as investors or people running projects, you have to be smart. You can say, okay, either I am going to take on this whole global culture and I'm going to tell people that actually mining is marvelous, or you can choose to go to the places where mining is supported. And I suggest that it's easier and quicker to, rather than break your teeth and avoid a hiding, go to the places and work on the projects which are not too complex in countries where they're going to let you work. And the exploration dollars at the moment are going into the US, but that's mostly on brownfield sites, because if you're trying to get federal ground, BLM ground, you can't disturb more than 5 acres of ground before you've got to do an environmental impact assessment, which takes 2 years and $500,000. So basically, that's just the guys that own the ground. The majors are spending big in the US. Canada, Australia, and Chile, the three other places where there's lots of exploration going on. Of course, Canada and Australia are marvelous, but my goodness, it's tough now to get your permits. And I've just met so I'm operating in Chile, and I was just out there and I met a French geologist who's running an exploration company in Chile, who said that she now has to pay $1,000 a day for someone to sit and watch as native title observation on every exploration project that they're doing in Australia. So it's becoming increasingly onerous and increasingly expensive. Of course, every project, every team is going to think that they can navigate the jurisdiction in which they work. But from my observation, and having worked up and down various countries in South America, Africa, Europe, Central Asia, I haven't done much in Australia or Canada. You know, you've got some places which are fundamentally eco-socialist, I call it. You know, in theory, they like mining, but actually, they don't. Europe, quite a lot of South America, quite a lot of Argentina is fundamentally anti-mining. Africa is, of course, a pretty good place to go mining, unless you want to be in West Africa, which is becoming so difficult in terms of security. The Congo is fantastic. It's really, really crazily good fun, but you've got to deal with operating in the Congo. I've been in the Congo. I've been there for a year. I've had 37 people taken hostage by the Force Démocratique de la Libération de Rwanda. Anyway, I'm in Chile. It's really good fun. We're finding loads of copper. We've got a heap leach project in the middle of the desert. We've got two big discoveries. We've got some really good rocks, and it's almost time for drinks. We're on an IOCG in the southwest. We've got huge geophysical anomalies. We're cracking on. We've got an analog system to Candelaria. We've picked up a completely new discovery at this place called Caballos, which we think is actually going to rewrite the metallogenic map of Chile, because they said that ate rocks but didn't continue that far south, and we've just proven that they are there 200 kilometers further south than previously recognized, and mineralized. We've got 200 meters at 0.5% copper and a bit of moly and a bit of gold. So that's all going well. We're working on the share price appreciation. We're working on momentum, value, and growth. And my goodness, it's wonderful having the backdraft, the tailwind of rising copper prices, and the fact that capital markets are coming back into putting this sector back into the spotlight. Thank you very much for your time.